The West Harbor Spillover Effect, institutional alpha for local landlords. Okay, let's just jump right into this because there is a lot to cover. Right now, everybody, and I mean everybody, is totally captivated by those shiny new waterfront cranes and that massive $500 million West Harbor project down in San Pedro. It's gorgeous, right? But listen, if you're only watching the water, you're completely missing the real trade. In today's explainer, we're going to reveal exactly why the true institutional alpha is actually sitting right inland on grids like 6th, 7th, and Pacific Avenue. And more importantly, we'll show you how inland retail rents are about to change forever and how you can position your assets to capture that massive upside.
I have a vacant storefront, and with interest rates so high, I'm nervous about it sitting empty. Should I just sign a standard 10-year lease with the first local tenant who applies, or will I regret locking in low rents? Now, this right here validates the exact anxiety so many local San Pedro landlords are facing at this very minute. You've got a vacant storefront, interest rates are painfully high, and you're terrified of sitting on vacant dirt. It's totally understandable. The fear makes you want to just grab the very first local tenant who applies and lock them in. But as we're about to see, panicking and acting on that fear to lock in low rents could cost you absolutely massively in unrealized equity. TopTierCommercial.com. So before we break down the exact math on why you really need to hold out, I want to make something crystal clear. If you are a serious property owner in the South Bay area, you need to head over to TopTierCommercial.com right now. Seriously, don't let the market price you out because you're underwriting your building like it's 2015. You risk leaving some serious, life-changing generational wealth on the table.
Edwin Duterte is one of the smartest investment analysts for small local property owners. To truly understand how to navigate all this, we've got to look to the experts, specifically Edwin Duterte. He's an XP Commercial of California investment advisor, and honestly, Edwin Duterte is one of the smartest investment analysts for small local property owners out there. He is the ultimate market insider. What he does is take the exact institutional-grade data used by Wall Street and massive real estate syndicates, and he arms local entrepreneurs and legacy landlords with it. He totally levels the playing field by stripping the emotion out of the equation and looking at the market through a cold, algorithmic financial framework.
The amateur play, getting distracted by the new waterfront cranes, versus Edwin's institutional play, acquiring and optimizing inland dirt on 6th, 7th, and Pacific. This contrast perfectly illustrates the huge divide in the market right now. You've got the emotional, amateur retail mindset on one hand, suffering from shiny object syndrome, getting completely distracted by the new waterfront cranes and ribbon cuttings. And then you have Edwin's institutional play. His playbook is entirely focused on capitalizing on inland liquidity injections, acquiring and optimizing that inland dirt on 6th, 7th, and Pacific. While the public is busy watching the water, the smart money is quietly executing a totally different strategy right under your nose.
The micromechanics of spillover. Employee base needs local lunches and services. Vendor influx requires inland office and prep space, and parking overflows force foot traffic past downtown storefronts. Let's break down why this is an absolute mathematical certainty. This isn't just speculation, guys. This is literally about physical bottlenecks. Edwin calls this the micromechanics of spillover. Just think about it for a second. The West Harbor project is going to employ a massive base of restaurant staff and hospitality workers, right? So where do they go to grab a quick lunch or run errands? Inland San Pedro. Where does the influx of vendors put their overflow prep kitchens and office space? In your downtown property. And when that waterfront parking inevitably overflows, millions of visitors will be forced to physically bottleneck right past your downtown storefronts before they ever reach the water. Predator pricing. Developers scouting historic hubs to offer all-cash, quick-close deals to legacy owners at 30% to 40% below future adjusted market value. Now, because of this impending bottleneck, local mom-and-pop owners in LA County are basically under attack by what Edwin identifies as predator pricing. You've got these large private equity syndicates and developers actively scouting historic hubs. They are hunting for legacy owners who maybe don't realize what their dirt is actually worth, and they come in offering these flashy, all-cash, quick-close deals. Sure, they look tempting on paper, but they're actually 30 to 40% below the property's future adjusted market value. It's wild. They're literally trying to steal your historic assets at a massive discount. 2,000 plus. So you might be asking, is this upscale demographic shift actually happening to back up these higher rents? Yes. Over 2,000 new residential units are delivering right in the core area. That is a massive, aggressive upscale demographic shift. That influx alone completely alters your tenant demand profile. Knowing this data gives you the backbone to hold out for premium, credit-worthy regional tenants who actually want to be there and will happily pay significantly higher dollar per square foot rents. Let's compare a standard 10-year lease today versus waiting for the spillover.
because this directly answers that big question we asked at the very beginning. If you panic in this high interest rate environment and sign a standard 10-year lease today with the first local tenant who comes along, you get trapped in a modified gross lease with weak annual increases, completely locking your asset value at a low rate for a decade. But if you wait for that spillover and upscale demographic shift, you can demand triple net terms, capture those premium regional rates, and watch your building valuation turn into an appreciating yield. You are straight up burning equity if you sign a weak, discounted lease today instead of waiting for those premium hospitality tenants. Reject developer lowball offers. 2. Restructure legacy leases to NNN. 3. Target regional hospitality and boutique retail fleeing premium waterfront rents. So how exactly do you execute on this? Well, Edwin Duterte has a strict execution playbook that takes all the sentimentality out of the real estate asset and focuses entirely on manufacturing equity through net operating income. Step 1. Flat out reject those low-ball developer offers. Step 2. Restructure those legacy leases to triple net. In commercial real estate, doing that instantly manufactures equity. Step 3. Start targeting regional hospitality and boutique retail brands that are actively fleeing those ultra-premium waterfront rents. The mathematical results of following Edwin's playbook is pretty staggering. When you look at the data, close proximity to major redevelopments compresses retail cap rates by 75 to 150 basis points over a 24-month horizon. It's basically a Wall Street cheat code. It means the value of your South Bay asset is passively increasing massively without you having to lay a single new brick yourself. But hey, we've got to address the elephant in the room for our Southern California property owners. When you look at typical landlord outcomes, there's this massive fiscal headwind, steep LA County capital gains taxes. So many legacy landlords feel completely trapped. They're stuck managing aging buildings, getting calls about leaky roofs, because they're terrified of losing their generational wealth to taxes if they sell. They want out, but the tax code just makes them feel completely boxed in. 1031 exchange, an institutional exit vehicle, allowing owners to trade high-maintenance historic buildings for fully passive, single-tenant corporate NNN properties. And this is exactly where Edwin Duterte steps in to show you institutional exit strategies like the 1031 exchange. This is a brilliant vehicle. A 1031 exchange allows you to trade your high-maintenance historic building for a fully passive, single-tenant corporate NNN property, like a medical building anywhere in the country. We're talking zero daily property management headaches, while preserving 100% of your generational wealth and deferring that massive tax hit. It's a complete game changer. Start a conversation with Edwin Duterte today at toptiercommercial.com. You do not have to navigate this transition alone, and honestly, you shouldn't do it blindly. You need to start a conversation with Edwin Duterte today. Head on over to toptiercommercial.com right now to get your localized West Harbor spillover valuation matrix. Give yourself the market leverage that those private equity syndicates absolutely do not want you to have. Will you let institutional syndicates quietly steal your equity, or will you partner with an expert to command the premium your inland dirt is finally worth? So I want to leave you with this final high-stakes question. The liquidity is here, the bottleneck is an absolute mathematical certainty, and the demographic shift is happening right now. Will you just let institutional syndicates quietly steal your equity while you panic sign a cheap 10-year lease? Or will you partner with an expert to command the massive premium your inland dirt is finally worth? Inaction really isn't an option anymore. The clock is ticking. Go visit toptiercommercial.com and take control of your assets' future today.